health, parenting, finance, travel, and home improvement. This is the Suburban Folk Podcast.
Welcome to the Suburban Folk Podcast. I'm Greg Rodersheimer, your host. In today's financial episode, we're going to focus on healthcare in America as well as life insurance. Both areas have a lot of complexity and unfamiliarity for the average American. My guest is Eric Geier. He's the president of Puresurance, who offers some alternative ways to look at both healthcare and coverage, as well as health insurance policies, in particular, making sure that you have a policy that's right for the coverage you need, as well as potentially as an investment tool. Eric, thanks so much for joining me today. Do you want to kick us off by talking about your background and give us a little bit more information about Puresurance?
Sure. So my background personally is in institutional equity sales. So for over 2 decades, I worked on Wall Street, both in New York and Hong Kong, servicing some of the largest asset managers. And a lot of and pension funds, a lot of which were managing the very funds where I'm talking about now. So now my wife and I moved down to Florida, and I wanted to add some value on a much more personal level. And I asked myself initially, what is the one area that is so incredibly inefficient where people need help? And that led me to health insurance, specifically to the small business owner, entrepreneur, freelancer community, because unless they have a spouse who's on some group plan that they can just get on, they're really forced to buy off the exchange or, a health share plan if they go that route, which is not really insurance, and we can talk about that. But also there are other private insurance plans that are medically underwritten that do provide a great value and just as good coverage that a lot of people don't know about. So that was basically my I guess, baptism by fire. And when I started talking to small business owners, it just became obvious how prevalent this problem is. So that, of course, led me to life insurance, the retirement aspect of life insurance, as my clients started asking me about that specific area. And so many people, not just my clients, but so many people in the country are ill-prepared for the retirement that is about to hit. And those traditional means of vehicles, such as 401k in this environment, really, I don't believe are going to cut it anymore.
Jumping off of your experience from the health insurance lay of the land, I remember when the ACA was first being rolled out. And to your point about relying on the employer for your coverage, or you've got the exchanges to deal with, I was hoping at the time that it would be a viable alternative, especially for people that are maybe not quite 65 yet, and they need everything else is in place for them to retire except for Medicare. Of course, when those prices came out, and I think I heard you say that when you really look at it, it's not really insurance. I'm assuming what you mean translating by that is the deductibles on a lot of these plans are very, very high. Of course, the premiums are also not super affordable. So as far as what you're getting is probably not really going to help other than a major, major catastrophic issue. So I don't think it bridged the gap, at least that I was hoping that it would. So I'm wondering if that's kind of a similar analysis that you initially saw with the exchanges. And again, I'm totally with you as well, that this connection between an employer group for everybody else and your health insurance is very strange, especially when you talk about people that are doing consulting or working for themselves, or as you mentioned, the small businesses who don't have the same capital to provide that kind of a benefit directly to their employer. So what other differences in the traditional health insurance model that people tend to be used to are there compared to what you're offering?
So as you know, the traditional model is premium, deductible, coinsurance, max out of pocket, and then everything above that. The problem is even if you're subsidy eligible on the health exchange, and that is as a single person making, between $12,500 and $50,000, you're going to get a great break on premium, but you're still going to be subject to what's likely to be a very high deductible. And, those people who can barely afford, their rent are basically functionally uninsured is the industry term for it. And that means that they're not getting any value out of their health insurance program, their health insurance plan, because they're never meeting their deductible. So that's a huge problem for that, right? So you swallow it because it does provide catastrophic protection, but it's not the optimal scenario. There are other vehicles out there that do make sense, that are medically underwritten, which means that you do have to qualify medically for them. So, if you have a history of heart disease, recent cancer, or insulin-dependent diabetes, among other stuff, chances are you're not eligible for them. But barring a serious health event, these plans are at a fraction of the cost of a major medical policy. There's usually no deductible whatsoever on anything outpatient, including surgery in an ambulatory center. In fact, the only time you ever see a deductible is if you're admitted overnight into the hospital, and the likelihood of that happening is incredibly small.
And as far as being medically underwritten, to be clear, what people need to kind of connect here is what they're doing with their employers or like the exchanges. They don't have that part. It's pretty much anybody that can get in, or once the insurance can sign up for it. Whereas medically underwritten, probably people are more used to that in the life insurance arena, I would guess, because it's more of a standard understood gate, maybe, if that's the right term. So what you're saying is for people that get through that gate on a health insurance type policy, and especially if it's a group of folks that are on the healthier side, just like life insurance, you will have lower premiums for the expectation that's concerned. What are some of the chronic conditions that may disqualify somebody from a plan? And then I guess on the other end, what should people be doing to make sure they do qualify for such a plan?
Yeah, so being proactive with your health is a great way to do it. Keeping yourself in shape, eating well, those are huge. But as you can imagine, the really insidious diseases, in addition to the three I mentioned earlier, stuff like MS, ALS, God forbid, all of those really horrible diseases are pretty much deal breakers. But if you've had cancer in your past and you've been free for 5 years, you qualify. So it's not an all or none thing. People get better, and maybe you weren't able to qualify a few years ago, but now you can. So, it's an avenue that's worth exploring if you are in a position where you want to see immediate value from your insurance, right? You don't want to pay a deductible, and you'd be saving a lot of money, and you're not tied down to any specific network. So, that's another thing. If where I am in Florida right now, there's a lot of Florida Blue plans that are great in the state. But let's say you go skiing and, you break your leg and you're at a network, and unless it's an emergency and you go into a hospital, they may not pay that at all.
Which is ironic in and of itself, right? Like anybody that dips their toe into the insurance arena knows, of course, that the emergency visits are the real breaking of the bank because of how expensive they are. Yet, right, if you're out of network and God forbid something happens, not with every single plan necessarily, but a lot of times the only way you have any prayer of it being covered is if it was deemed a true emergency that you go to the ED for, and then it ultimately gets paid. So that is kind of a wild thing of talk about reverse incentives as far as what the total cost is going to be and what you're encouraging people to ultimately do to get something taken care of. What else does the network look like from your perspective? maybe even to frame where I'm coming from, I feel like people talk negatively about the HMO or the network of you only have in-network. That never bothered me, really. I mean, you have to pick a cell phone coverage, right? Or you have to pick other types of services, and that's who you have. So I guess just for me, I've never gone to a certain doctor that I just absolutely had to have for the rest of my life. So that's just me and where I'm coming from. I know people are a little bit different. You mentioned some of those out-of-network benefits. What does that look like? For
one of these private plans, and let me just kind of state that the network means more to a woman than it does a man, because, we basically just go for our annuals. Women go for mammos and all kinds of stuff like that. So there's a more precise need there, as well as for the kids, right? You want to be able to go to a pediatrician who you want to go to, who your friends might go to, not necessarily what's offered in the HMO. What I mean by out of network, so in a traditional major medical plan, you may have to meet a deductible that's double the cost of your in-network deductible first, which is crazy. In private plans outside of the major medical arena, there's no disadvantage from going out of network. Because the plan itself is a defined benefit plan, you're going to get the same benefit whether you stay in network or out of network. The only difference is, in network, you can just basically show your card like a traditional plan, and the doctor files it on your behalf. If you go out of network, you would basically go into a provider's office, ask for the self-pay or cash price, pay it, and then submit it for a full benefit reimbursement. So that's the flexibility that these types of plans offer is great for anybody who's willing to take a more proactive approach to their health coverage. And it really does bring back the provider-patient relationship that the Blue Crosses of the world, tend to have brought down through, let's call it an assembly line rule of how they provide insurance.
And you're speaking my language as far as the cost, basically presenting yourself as a non-covered individual to get rid of some of the lack of transparency, if that's the right way to say it. Now, of course, recognizing, I know some people just absolutely hate negotiating for a car, right? They wish it was, here's a price for the thing that I'm getting. It's the same price for every single person. Well, gosh, just Google different tips to try to get the best price on a car and people's theories about whether or not you're going to have a loan, right? Versus if you're going to be paying cash, whether or not you're going to get a better rate and so on. So I feel like it's a similar kind of model there. Like I said, you're speaking my language, that I have no problem having those kind of conversations with a healthcare provider, or again, somebody trying to sell me a car, whatever it happens to be. I know there are people that are of the mindset that they just want to go to their doctor and get their care and feel kind of icky if they're having those kinds of how much does it cost conversation. But it definitely does put the power back and gets rid of that third party. I agree with you.
Yeah, one thing that really makes me nervous that I have to voice today is that you had a guest on, and I agreed with 95% of what he said, and he was talking about health insurance. The one area I did not agree with him were these faith-based health share. They're not policies. They've popped up all over the place, and it isn't insurance. And, I actually consult a lot of people who come off of these policies because they found themselves in situations where they thought it was going to be great because when they were young and it paid for the pregnancies, which are, very expensive at times, and they're great about that. But in other situations that come up, it's really at their discretion whether they're going to pay the claim or not, or how much of the claim or not. There's no guarantee around it. And it really defeats the purpose of paying a a premium. Of course, they can't call it premium, but paying a premium because it's all based on the transfer of risk. You're not transferring any risk if there's no certainty of benefit. So, I would just encourage people to, if they're looking at a health share or they're in a health share, to look at private options outside of the health share, because most of the time, the monthly outlay is going to be very, very similar, but you're going to get real insurance and you don't have to worry about, whether or not it's going to be paid if a serious issue happens, which is the reason why we're all insured anyway, right?
I'm glad you acknowledged that, because actually that was going to be one of my questions from the prior episode of the policy you're talking about. How does that compare to the faith-based? And as you can probably tell with what my perspective is, I've just been looking for general alternatives to what the gotchas seem to be with the exchange or being tied to the employer plan. And that was one of the first ones that I remember years ago being aware of as a potential alternative. I think I first became aware of it really as a way to frankly, get around the individual mandate, because that was actually a little bit intriguing to me that these plans seem to be in other or outside of the regular offerings, yet apparently it did qualify to basically put you in line with that individual mandate. So, there are definitely some restrictions, at least, that I'm still unaware of. So that's a good call out. And also, let me pick up on what you mentioned as far as the types of services. And you mentioned a delivery. Here's a different angle on that. And I'm curious how you feel about this, of the overall transparency. I remember seeing some sort of a documentary years ago, and it talks about the real cost to a hospital for a delivery. It's actually higher than what they are getting paid as compared to, let's say, like a CAT scan or something like that, that actually doesn't cost them much of anything. But oh boy, if you get a bill for one of those, watch out in most cases, especially if you have the deductible. And of course, the dig on that is they're basically doing their pricing based on our social idea of what something should cost rather than the actual cost of it. How do you view those kind of anomalies, and do they play a role in how your plan is set up?
So a good private plan outside of the scope of these major medical plans will look at the real cost of services done. Let's just talk about an ultrasound and imaging, something that a lot of people get. You could have a doctor's group that you go to who sees you and you're complaining of abdominal pain, and just go down the hall and we'll get you an ultrasound. Don't worry about it. A week later, you find a bill for $1,500 for that ultrasound, when you could actually go to an independent place 2 blocks away that might have that same ultrasound for $110. And that was actually a real live scenario for one of my clients, when he called me up and he says, he's like, Eric, he goes, they want me to take this ultrasound. It's going to be $1,500 here. The health insurance benefit is not that much. There are ways to bring down that cost, and independent imaging places are the best way to do it. MRIs don't cost $2,400, but it's a great way, as you mentioned, to recoup costs on other things by charging that. But a real MRI shouldn't cost more than $700. And, independent imaging places will charge that. And you know what? I want to give a shout out to a company called Green Imaging, and they will help you book any kind of imaging at centers all across the country for a fraction of the cost of what a doctor's group might charge for.
I love that. Even you mentioning that you're individually helping a client of yours be educated, as well as certainly companies that are able to do that. That to me is huge. And I don't know if I didn't mention in this episode, but if you would have caught in other episodes, actually my day job is in the managed care space. So I joke, actually I've told the story on the show before about my daughter breaking her arm. And luckily my wife, who is a physician, and me being in the space, knew some of the steps to take to, for example, not go to the emergency room and figure out like what kind of an ortho we could find for urgent care to keep that cost down. One other story I will share around like imaging. Gosh, I forget how many years ago this was. I wasn't quite as wise as I am now. Haha. But,
none of us were.
So I called the insurance carrier about the imaging that I was going to have done. And separate from the things that you're talking about as far as the different prices per provider, this was the same provider who, oh, by the way, was asking me to prepay, even though I was insured because they knew I had a deductible, which of course is a little bit of a different topic here. So I wanted to know what that total cost was going to look like. I got 3 wildly different quotes from the customer service people from the insurer. I want to say it was right. It was as low as actually about $700 up to like $3,000 some odd dollars. They had no idea. And even when I'm trying to be proactive, it's like, well, you're going to roll the dice because that's the industry we're in, and you'll know when you get the bill, which is of course just outrageous for any other industry.
It's outrageous. And, there have sites that have popped up like MD Save, where you can type in what zip code you're in and what procedure you're looking at, and it'll give you an indication of the real price of these things. So all you need to do is be willing to dig a little bit. And when I give my web address later, I do provide a resources page on there that you can just take a look at. And there's great resources on how to save money if your listeners are uninsured or underinsured. It'll really help them out a lot.
Like I said, I'm definitely all about any of those kinds of tips. We haven't really talked about pharmacy, but for example, GoodRx, right, is probably the most well-known way that even if you are insured, I'll say for me, like there's hopefully no way I'm ever going to hit my pharmacy deductible in a given year. So it does not make sense for me to even show them my insurance card. Again, typically GoodRx has got some really good deals. And depending on the carrier itself, actually, again, I'll share it. I was put on a very common daily prescription that's free at one of our local grocery stores. So yet another instance where it quite literally pays to shop around a little bit. And hopefully people are starting to get more in that mindset. Like I said, yeah, I get how you wish it wasn't the case that you have to be an informed consumer for your own health, but it is the case. And it is something you just need to be educated on.
Yeah. And I kind of liken this to trading. There used to be market makers who would make a pretty wide spread in a stock, right? And you would buy at the ask and you would sell on the bid. But then electronic brokers came in and started cutting that spread, lower and lower and lower, making it more narrow. And that's what GoodRx has done. There's other firms out there like Drexy who do a cost plus model where they take the actual cost of the medication and then they just add a small surcharge for the user, and that's your price. So sometimes Drexy is even better than GoodRx because they're not taking any spread whatsoever on the cost of the medication versus what the pharmacy charges.
Good tip. And another interesting way of again, how the money changes hands. Why it's ended up this way, I guess we're not going to
all the money.
Yeah, that's right. And we won't be able to unravel all of it here or ever. But as long as you can figure out how some of those things work and some of the levers that you can pull, all the better to be able to do that. Well, before we move over to the life insurance piece, is there any other major characteristics of the policy we're talking about here that people should be aware of that is different from what they might be used to?
Sure. So the one thing that works really well with this policy is an ER visit, believe it or not. So anytime you go into ER, you always go in and self-pay, because if they know you have insurance, they're going to mark it up as much as 1,100%. And I had a client who was having chest pains, and her doctor told her to go to the ER. She calls me up, and this is in Houston. She calls me up and she's like, "My doctor's telling me to go to the ER. I know it's expensive. I don't know if the benefits that we have cover it." So I said, "Well, if you have chest pains, go to the ER." So she goes to the ER. They did a bunch of tests. $3,700 later, she was on checking out, and they were asking her insurance, and she said, "I self-pay." And they came back and they said, immediately they said, well, can you afford, $1,700? And she's like, no, not really. And they said, how about $655? She's like, done. So she puts her credit card in there, pays the $655. The ER benefit from this particular policy was $800. So she made $145 on that ER visit. Those are things you can do that nobody knows about doing, but they're simple strategies that will make you not only not owe a lot, but in a lot of times profitable on these things. Now, profitability isn't a goal when you're going to the doctor, but it happens more often than you think.
I both love that and hate that, right? I love the story because it is somebody flipping the script on the system that we have right now. Of course, I hate it because that is crazy of what the original price that was quoted down to, now all of a sudden they think based on somebody else that's saying they're not insured, they may get nothing from it. So they're willing to take much, much less after the fact. Let's go ahead and move over to the universal life. Now, this is definitely an area that I don't have as much background in, and speaking for me personally, I've so far come from the school of term insurance. It's supposed to be the insurance benefit as a death benefit. Don't intermingle your life insurance with what you want your investments to be. Recently, I've expanded my knowledge at least a little bit more. And where I sit today is I almost think of universal life or whole life as more of an investment than even any kind of insurance. So it's almost like they should change the name of it. So from that standpoint, tell me a little bit about whole life, which I think has been around longer compared to universal life, which my take is it's a little bit newer of a product.
Right. So you buy whole life for one of two reasons. Basically, right, for the death benefit, right, for you're mitigating estate taxes, or let's say you have an adult child that's going to live past you who has developmental disabilities, and you want to provide for it. It's a great tool for that. The problem with whole life is that there's fixed premiums, and if you miss a premium, you have to surrender the policy, right? You have to pay that policy every month at that price because it's giving you a guaranteed cash value, or until you die, or you have to surrender it and take its cash value. That's the biggest drawback from it. With a universal life policy, you're focusing less on the death benefit and more on cash value accumulation. So the policy is much more affordable. And with the way that we construct them, for example, we pad them enough where you would be able to miss, let's say, several payments if you ran on bad luck, and it wouldn't render the policy void. So, we create that padding for you so you don't run into trouble if you have problems paying the premiums, for several months. And it's a great investment from a perspective of managing volatility, because these universal life policies track an index, the index universal life policies, and they don't directly invest in them. You appreciate the upside gain, but you're protected from the downside losses. So everyone knows that, if an investment falls 20% in a year, you have to make 25% the next year just to get back to zero. You're stopped out on these policies at zero. So your money is going to grow a lot quicker because you don't have to make up that negative territory. And, if you analyze an investment from the last 20 years, it probably returned, the S&P returned about 5.9% before expenses over the last 20 years. We're in the same kind of ballpark, a little bit better, 6 to 7%. And, you don't have to worry about these excessive management fees that come with, other investments like mutual funds and sometimes equity investments.
I'm glad you called out the premium, because that is definitely, again, in my current understanding of whole life, at least anyway, my major concern, i.e., just what you said, if somebody falls on hard times and they can't meet that premium, well, they're going to lose the policy. And so I don't care what kind of return they're getting on those, it's gone. And that is not the case, of course, with investing in a 401k or whatever else you're doing with your equities. Yes, to your point, you could lose value when the market goes down, but you can stop being required to put in more money. So that is a very important distinction, I think, between the whole and the universal life. You mentioned the index tracking. Is that a specific index relative to universal life that it tracks, or are we talking about tracking like S&P 500 as an index?
The S&P 500 is the most common that it tracks. And what it does is it returns up to a cap rate, so you're not going to get the full benefit of the index when it goes up, but you're going to be protected from the downside. So, it's really there to manage volatility, and to protect your money from these huge, let's call them gyrations in the stock market, right? Because let's say, you're retiring in the next 5 years, you have a $500,000 built up in a 401k. Your two greatest risks are the market falling right before you retire or right after you retire. Because not only do you have to make more to get back to zero, you're taking income from that money at the lower level. So it's a pretty dangerous perspective if you have all of your money tied up in a vehicle like the 401k. And the 401k has its place. If you have an employer match, for example, you should absolutely contribute up to the employer match because you're getting free money. But above that, there are better investments to make aside from a 401k.
Are there certain limits on the universal life both ways? Is there a limit as far as if you make a certain amount of money, let's say the tax advantages are not quite as rich as they otherwise would be, and then vice versa? I guess from your personal perspective, should their budget be in such a way? You mentioned, for example, 401k, if you have the match, at least get that in there. Or any other budget considerations before they would look to open this kind of policy?
You want to be able to build a cash value in an IUL. And for that, you want to have at least $300 a month to be able to, at a minimum, to be able to open up one of these policies. Typically, they're for people who make at least $50,000, but realistically more towards $70,000 to $80,000, because in truth, you should have a diversified portfolio between tax-free, tax-deferred, and taxable investments. So in the 70 to 80 range, it's a bit more comfortable, and it doesn't put such let's call it a strain on your income. But for those who already have investments built up, oftentimes what I'll do is create an elaborate report that just kind of tweaks a few things, a reallocation that can make a huge difference. To somebody's retirement plan. It could be the difference between a successful and retirement failure. And think about it. Like, the average person is going to be retired for 20 years, right? If you're a couple, you have a 50% chance of living to age 90 and a 5% chance of living to age 100. So you can't just prepare to 85 anymore. You have to prepare to age 100, because the worst possible thing is longevity risk, right? You never want to outlive your money.
And also, sticking with the tax advantages, can you tell me what are the tax advantages of the account, and then what's the limits of those?
So you can pretty much put in what you want. There's a tax-free death benefit. It's tax-deferred cash value accumulation, and you can take tax-free loans and withdrawals on it. So it's a great product. It forces you to pay your taxes now instead of in the future, like a 401k. So you really have to ask yourself, where do I think tax rates are going? Right? So we're at 37% now. We're staring at a $30 trillion deficit with this last stimulus package that, the checks that went out. And there's a $3 trillion proposal for infrastructure on the table. So we just can't continue to print money. So the logical place to go after this is retirement accounts. And if you think the future tax rates are going to be higher than they are now, which, pretty much everyone in the know does, it might be better for you to think about paying taxes now and being in investments where, you can let that money grow tax-free and take it out tax-free. Roth IRAs, for example, are great if you can contribute to those.
I feel like the newly emerging running joke I have is, I want to say every single financially savvy person that I've had on the show, when I ask for future predictions or anything like that, it is pretty much categorically not a matter of if, when taxes will be higher. And of course, like you mentioned, for a Roth or being able to have something tax deferred currently, used to be, okay, do you think you're going to be making less money in retirement compared to in your working years? Now it seems like, well, even if you are, the chances of the bracket that you end up in, it may be a lower bracket, but those levels will probably have risen as well. So it's quite possible that you'll still be in a higher tax bracket, even if you're bringing in less money.
And if you're in tax-free, let's call them, quote, tax-free investments like municipal bonds, for example, while those may be tax-free, it does add to your provisional income. So, you're going to end up paying more than you would, with those investment vehicles in your portfolio than you thought you would.
Now, let me go back again to the relation to term life and something like a universal life. As I mentioned, my head has now kind of flipped to really viewing something like a universal life really more of as an investment than the actual insurance for death. Kind of, for example, like you're mentioning, the accumulation. So you only have available as you're accumulating, whereas when you buy a term policy, well, there's that death benefit. So regardless of, God forbid, if you die and that is the money that's available. Do you view those two products being complementary in some way? Or in other words, you buy a term life, let's say for a certain amount of time while you're accumulating the universal life, and then maybe if it hits a certain threshold, you let the other expire? Or do you feel like universal covers both an investment vehicle as well as what you would presumably need as a death benefit?
So term life doesn't have any cash value tied to it. So, it either pays out or it doesn't. And in truth, about 2% of all term policies pay out. It's hugely profitable for insurance companies. Do I recommend it? I do, for a young family. You're 24, you're starting a family. It doesn't cost anything to have a term policy when you're 24 and healthy. The one caveat, the one advantage that a term policy would have as it relates to a universal life policy is that your health profile, when you qualified for your term policy, assuming it's convertible, will grandfather you in to a universal policy, and your premiums will be less. It'll be less money for you to buy that policy, because as you get older, you get health problems, right? Insurance becomes more expensive. If you can grandfather yourself into your profile when you were 24 years old, it makes sense. It can mean a real difference in the cost of your permanent life insurance policy.
Does that same idea of how healthy you are, I assume in some way, but going back to even the underwritten part, when you get a policy open, you have to go through some sort of evaluation to show how healthy you are. Now, with the universal policy, it's the cash that you're putting in that accumulates and accumulates. How does that coincide with somebody that's healthy and gets a better rate? Does that also mean some sort of a better investment rate as the policy continues versus somebody that's not as healthy and maybe they're having to pay a little bit more? Is there any relationship, I guess is what I'm asking, between how healthy you are when you take out the policy, what you're paying in for the premium, and then again, does that affect on the back end how your returns may function?
Your returns will be better if you're healthier because you'll have more money to invest in that policy, right? So the cost will be less. So in a way, yes. And look, when we're drawing up a plan for a client, we're